A lot of you guys are asking me about the interest rates and what to expect in the next upcoming year or 2 or 3, whenever your renewal is. And obviously, there's a lot of uncertainty, and there are some big changes, especially in the interest rates, because we no longer have the 2 or 1.5% available. Now we're looking at the 6% interest rates. Maybe it'll go up, maybe it'll go down. So I just wanted to really dive into the payments, what that's going to look like when it comes down to the dollar figures and the difference, how much you're going to be overpaying in the next, few years in the next term, and give you some suggestions, options of what you can do moving forward, and hopefully that will help. Okay, so here's the mortgage calculator. I found this one at realtor.ca. I find it very, very helpful because it gives you 3 or 4 different scenarios. And so what I've put in is the asking price is $1 million. That's kind of the average we get in the Okanagan for a single detached home. And we basically have 4 different scenarios. You see $1 million here. We're putting down 20% on all of them, which is $200,000. And then the only thing that we are changing is the actual interest rates, your mortgage rate. The amortization period is the same, so that's 25 years. That's what you usually get. Now, if you can make the payments, or one of the options is to extend this and it'll lower your payments. Some bank will suggest that, or mortgage brokers. And this is really what it's going to come down to when you're looking at the monthly dollar figure, right? So we're just, for easy calculation, that's what we're going to be going with. And so you can see if you were at 2%, some people are even lower. You were at 3,400, and if you're going to be renewing at 4, it'll come up a little bit. But you really, like, if you'll be around 6%, you're looking at almost $2,000 increase, right? If you would go to 8, it's almost doubling, right? So this is very important to put into your planning and consideration for whenever your renewal is going to be coming up, so you know that you can manage the payments for your mortgage. Because I'm seeing a lot of people that, the ones that had variable, that they are struggling right now because their payments went significantly up, and or some of them that had builders mortgages, they just couldn't manage, and they had to let go of their dream for now, and sell their property and move on. So very important that you have a good planning. So we're looking at the first scenario, and this is very, like, we get into this nitty-gritty details, but you can see this would be basically the total amount of that you paid in the 5 year, because we were looking at 5-year terms, right? So this is how much you would pay in total, right? Including the principal and interest rate. So in the beginning, you always pay more on the interest rates, and then you start slowly paying the principal. So you can see it's $73,000 paid on the interest rates, and actually, in this case, you would be paying more on the principal. And then here we're going to look at the first scenario, which is 2% interest rate, and we're looking at the 5-year term, right? So you see, this is the 5 years. This is the total amount. And you can see at 2%, you're actually paying more on the principal than you're paying in the interest rate, right? And your total that you would pay off is $203,000. Your principal in the 5 years, you pay $129,000, and you paid $73,000 on the interest rate. So your balance would be $670,000, right? Now, you can look at the other details, but we'll go with the 5 years because I'm sure that things will change. No, so now we're going to go with 4%. So your total, now you're paying $50,000 more with the same numbers, just the interest rates changed, right? So we're going from 2 to 4%. So $252,000, your principal paid is $103,000, and your interest, so you paid more on the interest than in your principal in the first 5 years. And now look at this, right? Your leftover mortgage or balance at the at the end of the 5-year term, it's almost $700,000, right? So you can see you only paid $100,000 in the 5 years on your principal. So now let's go with the 6%, which is what we have right now. And this is how much you're going to end up paying on the 5-year term. So $307,000 principal paid. Now that is less, obviously, right? Because you're paying more on the interest. And how much are you paying on the interest? It's $225,000. So you only pay $81,000 off your mortgage, and this is what you're going to carry on into the next 5-year term. So obviously, when you're looking at this, you want to have some extra payments on your mortgage to help to pay and lower this, because that'll lower that, and you end up not overpaying as much on your mortgage, right? Because when you look at the overall numbers, right? So your mortgage is $800,000 in a 30 years, which hopefully that obviously is not going to stay that high for that long, but you would be paying on your interest 735, 1.5 million in total for $800,000 loan. We can go and try we had this one set at 8%. That's even crazier. So you'd only pay $62,000 on your principal. Your interest rate in 5 years, $303,000. So total 366, and you'd have $737,000 left on your mortgage. If you would look at the 25-year time frame for $800,000 mortgage, you would pay $1,031,000 on your interest rates, right? And your total for that and this is $1,831,000.